Why is the inverted yield curve so special, and why does it usually anticipate recessions so well? Well, to understand this, we first need to know what the yield curve is. The yield curve, as you can see in this graph, is simply a graphical representation of interest rates at different maturities: 1 month, 1 year, 2 years, 5 years, 10 years, etc. As you can see, this curve is steep. It's steep because short-term interest rates are smaller than long-term interest rates. Why is this? Well, it's simple. When you lend money to someone, you want them to pay you back as soon as possible. So, to get you to lend them money for a longer period of time, they have to offer you more money. They have to compensate you for the wait, as well as for the greater risk of lending over a longer period. On the borrower's side, it's the same. When you borrow money, you want to pay it back as late as possible, so you'll be willing to pay a slightly higher interest rate. So, we're starting to understand why the yield curve is normally upward sloping. It means that when the yield curve is inverted, short-term interest rates are higher than long-term interest rates. This seems to make no sense, because if lenders prefer to be paid back in the short term, why are they asking for more interest on short-term loans and less on long-term loans? And why would borrowers want to take out short-term loans when they're being charged higher interest rates? This is what makes the inverted yield curve so rare and why it has to mean something when it's like that. Alright, with this we already understand what the yield curve is and what its normal shape is, which is upward sloping. Now I'm going to show you a graph on the screen where the blue line represents the difference between the 10-year and 2-year interest rates. So, when the blue line is above zero, it means that the 10-year interest rates are higher than the 2-year interest rates, which indicates that the yield curve is normal, with higher interest rates for longer maturities. However, there are also times when the blue line is below zero, indicating that the 2-year interest rates are higher than the 10-year interest rates, which means that the yield curve is inverted. In addition to that, what are we observing in this graph? We are seeing some horizontal gray lines, which represent periods of recession. We can see that every time the yield curve inverts, meaning the blue line is below zero, a recession occurs shortly after, typically within 6 to 24 months. Therefore, an inverted yield curve seems to be a reliable indicator of an upcoming recession. Now that we know that the yield curve predicts recessions, the question is, why? The monetary explanation for this phenomenon is that when the economy is doing well, when there is a lot of consumption and investment, there is a danger that the economy will overheat and inflation will begin to appear, and central banks are afraid of this because their mandate is to have controlled inflation. Therefore, in this context, they begin to raise short-term interest rates so that the economy does not overheat too much. Since high consumption and investment lead to higher prices and inflation can get out of control, and the mandate of central banks is to control inflation, they raise short-term interest rates at this time to prevent inflation from getting out of control. As interest rates start to rise, it becomes more expensive to borrow money to buy or invest, so the economy begins to slow down. At this point, entrepreneurs who had borrowed money and had expectations of demand now see that their demand is lower as there is less consumption in the economy. Therefore, they cannot repay their debts within the agreed time frame with their lenders and have to refinance their debt, meaning they borrow more money for a year or two to repay the debt that is currently due. As a result, short-term interest rates continue to rise because many entrepreneurs are borrowing money. If interest rates rise too much, there will be entrepreneurs who cannot pay them, so bankruptcies will begin, which will also affect laid-off workers who will consume less because they have less work, and this will cause other entrepreneurs to go bankrupt, creating a vicious circle. Furthermore, due to how the banking system currently operates, banks finance themselves on a short-term basis and lend on a long-term basis. They make money from this business model because, normally, short-term interest rates are lower than long-term interest rates. As a result, banks borrow money on a short-term basis and lend it on a long-term basis, earning the difference in interest rates. However, when short-term interest rates rise, banks have to pay more in interest to finance themselves on a short-term basis, and their banking business becomes less profitable. At this point, banks may stop lending money or lend less, which obviously harms the economy. This is why short-term interest rates are higher than long-term interest rates. In the short term, there is a lot of uncertainty about whether companies will be able to repay their debts or not. But in the long term, there is less uncertainty because it is known that if the economy starts to decline, central banks that had raised interest rates will lower them again, which means that long-term interest rates are lower than short-term interest rates. However, does the current inverted yield curve mean that there will be a recession? It is likely, given the current problems and uncertainty, but not necessarily. The fact that the inverted yield curve has predicted past recessions does not mean that this relationship will always hold, as the economy evolves and the relationship between variables can change. Nonetheless, it is not a good sign. I hope you found this video interesting and helpful. On my channel, I'll be sharing more content about economics and finance, so if you enjoyed this video, please support this channel, and if you want me to explain any economic concept or news, leave it in the comments. Thank you for watching the video and see you in the next one.